what we're going to be going over today is MACD and momentum trading. Okay. Now, with MACD, kind of like I said before class, something you don't really hear me talk about very often, and I've kind of been, I don't know, kind of back and forth on using it, but I've been starting to use it more lately again. And it's kind of like the candlestick patterns. It's like, not that I necessarily forgot about it, but like there's like 20-25% of the stuff that I didn't really pay attention to that I haven't been integrating into my trading. So it was funny. Last week I was going back through and I was going back through MACD and like kind of back testing a bunch of stuff. And I was like, dude, I need to start using this indicator again because it provides really nice confluence with your trades, especially with M's and W's. So MACD, what is it? It's moving average convergence divergence. Okay, so basically it's just a convergence of two moving averages or a divergence of two moving averages. Okay, it uses three numbers to operate. You have two EMAs that it takes the difference of. That is your first line. Okay, and then you have a signal line, which is usually a 9 EMA. Okay, so when you go into your settings, you'll see a fast length, which is the quicker EMA, normally the 12. You'll see a slow length. Okay, it's the slower EMA or the higher time frame EMA, which would be the 26. And then the third number is the signal line. All right, and that's the line that creates the crossover effects. So basically, the first line is calculated by subtracting the 26 EMA or subtracting the 12 EMA from the 26 EMA. Okay, and basically the subtraction of that creates what most people would have as a red line, which is basically the slower line of the two. Okay, it's the smoother line. It doesn't move. It doesn't have as much vertical movement. And then the 9 EMA is just a regular 9-day EMA. Nothing super special at it, but it creates kind of a smoothing effect for the indicator. So almost all charting software is 12, 26, and 9. Okay. You can fiddle with it, but I really wouldn't recommend it. And the reason why is that this is a widely used indicator in the industry, and almost everybody uses these same numbers. Okay. The algorithms are programmed with it. Every other floor traders, retail, me, well, I'm a part of retail, but we all use the same indicator. So trying to fiddle with it and have something that's different could be misleading, because when 90% of the market is using it, it's obviously the stock, the algos are going to respect it, right? And obviously we want to trade with the algos. So you can fiddle with it, but I wouldn't suggest it. Okay, just use the default. Okay, so here's just a quick example. All right, this red-orange line is the difference of the 26 and 12 EMA. Okay, you can see it doesn't have as much vertical movement as your signal line, which is the blue one, which is the 9 EMA. All right, so just blew this up. You guys are, I'm assuming, familiar with this. And then also you have the histogram here, and we'll get into that right here. So the histogram mirrors the difference of the two EMAs. Okay. So basically, as the two EMAs become farther, or the two EMAs become farther apart, the histogram also gets either taller or shorter, depending if we're in a bearish momentum or a bullish momentum. Okay. The larger the histogram bar, the higher the momentum. So all it's doing is really just measuring the space between the 26, 12 difference and then the 9 signal line. Now the 0 line, which is basically the line where you don't see a histogram on the bottom or the top, where momentum is neutral or quote unquote 0, that is the bullish and bearish line. Okay. If you're over that 0 line, you are bullish. Okay. Even if you have a bearish crossover in the bullish counterpart, it's still bullish momentum. Okay. Now, if you're below the 0 line, you are bearish, and you are bearish until you get back over the 0 line. Same thing with the bullish. Even if you get a bullish crossover, on, in the negative side of the MACD, that does not mean that we have full bullish momentum. It just means that we're having a profit-taking pullback, usually, or a potential trend reversal. Okay, but you still have to keep in mind that the momentum is still bearish, even if you have a bullish crossover. Lower momentum usually equals consolidation. Okay, when momentum is pretty flat, most times you're going to see a chart running sideways, and that's in relation to the zero line. Okay, so if the MACD lines are hanging right around the zero line, most likely you are in consolidation. So basically, just got the histogram here. What I do want to note is that, kind of like what we talked about, even though the MACD is bearish here, the histogram is not measuring the zero line. Okay, because this is the zero line where anything above is technically bullish momentum and everything below is bearish momentum. But all the histogram is doing is showing basically that you've had a bearish crossover, right? And then it's providing the measurement of the space between the two lines. Okay, so up here, even though you have a bullish or a bearish histogram here, we still have bullish momentum because we're above the zero line. All right, and then you can see once we get below the zero line, we get even a bigger histogram to the downside, right? Bigger space in between. And then while we're in the bearish, you can see we go ahead and flip, right? Because we have the crossover of the MACD, and you get the green histogram. Okay, but still keep in mind we're below the zero line, so it's still bearish momentum, but the histogram is showing basically the crossover and then the distance that you're getting between the two lines. So one of the ways to play is the zero line crossover. Okay, this is usually a lagging indicator, a lagging crossover, more lagging than the MACD crossover, which we'll get into in a second. But it's also the safer one. Okay, so basically what this is when we're getting the MACD crossing the zero line. Okay, when we're getting both lines crossing the zero, either into a bearish state or into a bullish state. Okay, so when we're above the zero line, okay, we don't want to fight momentum and trend. All right, so anytime we're taking a short side trade when we have bullish momentum, as in bullish above the zero line, short side is usually scalp only. Okay, there's way more meat on the bone on the long side. When you're below the zero line, bearish. Long side is scalp only. Okay, I don't care if the MACD crosses over or not. If you're below that line, long side is usually scalp only. There's way more meat on the bone short. Okay, the zero line crossover signals like significant change in directional momentum. Okay, it's basically saying like, hey, both EMAs are able to make it over the zero line, and it should affect your bias. Okay, because we are flipping momentum and most likely flipping trend. Okay, usually when that's flipping, that is solidifying that we're flipping trend, especially on bigger time frames. Now, if you're using this on like a 1 minute, okay, you got to be careful with MACD on the 1 minute because it gets real whippy, right? It's a lot of data. So MACD is better used intraday, probably on a 5 minute, if you're only using one singular time frame. Okay, but where these is really effective, in my opinion, is like on the hourly when we're looking for multi-day swings. Okay, so right here we got an example. You can see that we have a crossover. Now notice that the MACD crossed over up here, but the momentum's still bullish. And I want to point this out. We have the crossover right here, but yet we go ahead and get a bounce right before we actually get the true drop. And that's because the momentum is still bullish, right? So when you see this, we're not looking for a swing yet. We're looking for a scalp, because most likely you're going to see a pop back right before we get the real move down. Okay, so I just want to point that out. So we crossed right here, right? And I drew the arrows where we crossed. And this is what I mean by sometimes it's lagging. Okay. We crossed, right? But we didn't really move, but we stayed under it. We basically came up and retested the 0 line and rejected it. And then we had the momentum down. Okay. So this is just kind of a way where you can be like, okay, cool. I have both lines crossing. We're below, we're into bearish momentum. And now you can kind of see, okay, we're developing kind of an M pattern, right? And you mix that with fibs and other indicators, it's probably going to give you a really good reason to take an entry. All right. Over here, we have the same thing. Okay. We have a crossover right here. You get a small little pullback, and then we actually go ahead and get the move up because we started getting more bullish momentum. Okay. So this crossover is when it crosses the 0 line, not when the lines cross themselves. Okay. I also want to point out that down here you had a MACD crossover. Okay. But yet we had further downside. Kind of weird, right? Even though the momentum is going up, it's still bearish because we're below the 0 line. Okay. So I want to make that very clear. Just because you have the crossover and it's going up, if you're under the 0, your momentum is still bearish. And a lot of times you'll see a chart like this. All right, and that's something we also call divergence, which we'll talk about that here in a bit. Okay, just another example here. So we get a crossover here, right? Get a little bit of a fake out, that's okay. Still would have been a nice move if you would have taken the crossover. And then you get the crossover again here, and then you get the real move, right? Created a W pattern. So every time this crossover doesn't mean you're going to get an explosive move. I mean, you still got 10 points, right, from the cross or ish, 8 to 10 points. And then you kind of have this pullback, right, in momentum where you're kind of screwing with the 0 line, like which way is the stock going to go? But then you can kind of see this W pattern forming. You mix that with a trend line break, a 38 break, and then the MACD flipping. I mean, it's a pretty slam dunk trade, right? A lot of reasons to take that trade there. So this is the 0 line crossover. All we care about is the lines crossing the midline. Okay, that's what we're talking about here. All right, so the MACD crossover, which has to do with the actual lines themselves crossing each other. It's an early indication of a potential trend reversal. Okay, but a lot of times you're going to see that you're going to see a bearish crossover in a bullish momentum setting. Okay, so when we're sitting above that 0 line, you're going to see a bearish crossover. All right, it's an early indication, right? But you need some confluence, all right, and you need some proof that the stock actually wants to come down, because all you're really seeing is just a pullback of momentum, not a momentum change. So if the MACD crossing is happening below the 0 line, okay, kind of like what we just talked about, it's an early indication of a bullish reversal. What you're normally going to see is in the stock, when this happens, is you're going to see a small pop and then a pull, and then you're going to kind of get the real move. And what you're going to want to see is continued upward momentum to cross back over the 0 line. Okay, and I got some charts that'll explain that or show you that. But basically, if you have the MACD crossover in the bearish setting, all right, normally what you're going to see is you're going to see a small pop, you're going to see a pullback, and then it's going to decide if it's going to get the real move or not. And what you're going to want to see is you're going to want to see that the momentum is continuing to that 0 line, okay, if it's crossing over in a bearish setting. It's a lot like an M or a W forming. In that case, it would be like a W. Same thing for the bearish reversal, okay? If you get a MACD bearish reversal and it's over the 0 line, okay, it's the same thing. You're going to see a pull, a pop, and then the real move, okay? And what we want to see is continuing momentum downwards back to the 0 line, okay? We want to see that bullish momentum make its way to being bearish momentum, okay? But it's usually the first indicator that you have a potential of trend reversal. All right, so we got our chart here, okay? Obviously, we're come down in a downtrend here. You got an M pattern kind of depleting, right? Double bottom. And then you have bearish momentum going into it, okay? Notice we get the crossover right here. We get our pop, right? Which would be what we call our profit taking pullback. Okay. We get some indecision where we come back down, right? And then we get another crossover right here, and then the crossover of the zero line really short after. And then you get the real move. Okay. So this is what a lot of your charts are going to look like when you're looking at this, you know, on an hourly or 4-hour MACD. All right. You're going to see the basing, profit taking, pullback, and then go. Okay. It's just like playing a W. Okay. On this one, all right, we got a crossover, but we're above the zero line, which means we're in a bullish setting. Okay. You can see that we get a slight pullback. And then you get another pop, right? But notice that the momentum's not really following, all right? And this is what we call divergence, which we'll get into. But you get your pullback, you get your pop, and then you get your real move, okay? And then as we get this across the zero line, that's when we start really moving down, okay? Because right here, we're moving down, you know, after this initial pop down, we're kind of moving down, but we're kind of chopping. But notice once we cross over, we go ahead and get that flush. You get a nice, you know, 30-degree angle down on a downtrend. Okay. So just because it crosses up here doesn't mean immediately we're going to come down. You can see that usually what we have is a scalp down, a pop, and then a move, the real move, right? And since we couldn't really cross over here and started getting deep on the histogram, we had that momentum come on down. Okay. But we can't really consider it bearish bearish momentum until we get this across the zero line. All right. Just want to keep reiterating that because a lot of people don't even know that. They just buy the crossover and play the crossovers and they get burnt and stop playing MACD. All right. So bullish divergence. Now, I don't know if there's names for these. I kind of made my own. Okay. There's two different divergences that I play using MACD. The first one is inverse momentum divergence. Okay. And it's when the price is moving opposite of a recent MACD cross under the zero line. Okay. That was kind of like the chart I showed you earlier where the first time I said we had divergence. I'll pull that up here in a second. Okay. To reiterate, it's when the price is moving opposite of a recent MACD cross under the zero line. So let's say you get a bullish cross under the zero line of the MACD, but yet the price is continually going down. This is what I call inverse momentum divergence. Okay, because realistically, according to the momentum, the price should start basing and moving up. All right. The second type of divergence is structure divergence, okay, which is momentum making higher lows, right, while price is making lower lows. Okay. So basically, you have price find a bottom. Let's just talk about a cipher pattern. Most of you guys know what a cipher pattern is, where the C point is lower than the A point on a W. Okay. The A point, you get the bottom, right? And so the momentum curls there. And then the C point is lower in price than A point, but the momentum of the C point is higher than the A point. Okay. This creates a divergence. Basically, you have an uptrend in momentum and a downtrend in price. Okay. That's what I call structure divergence. And basically what it is, it should perk your ears. It's a signal of trend reversal, right? Which is all what we're looking for when we trade stocks. Trend reversal. They also can be used to take profit as well, guys. Okay, it's not just an entry. They can be used to exit as well. So basically what we got here, okay, this chart I showed earlier, we have a downtrend, right? You have a momentum flip that starts right here. We get a little bit of upside, but we really continue making downside and kind of have a slight downtrend going, even though we have a steady uptrend of momentum. Okay. Basically, we can see, though, that with this divergence, this could basically lead us to having cause to be ready to take a reversal. You know, and what would be a better place than drawing a set of fibs here? Your 11 or your 23 is going to be right here, and you get a beautiful break and get this play, right? So these are things that we want to be looking for when we're using the MACD, is looking for divergence, okay? And the higher the time frame, the better, okay? But also the slower, all right? The higher the time frame, the more you can trust it, but it's also slower. It's going to take longer for you to realize that divergence, as in actually get the move off the divergence, okay? So inverse momentum. We get a crossover and momentum is significantly going up, but yet price is still going down, okay? Now this one is structure, okay? Somewhat similar, but a little bit different. All right, so you have a point here where we had a reversal, right? You can see right here on the momentum, but yet we have significant price drop, but lower momentum, right? Our momentum is not as bearish as it was at the first point, even though the price is 20 points lower, okay? And look how long it took for us to realize this divergence for the reversal, right? You're talking almost a week, okay? So how would we use this? Well, we'd have our trend line drawn. We'd have a set of fibs, break trend, break 11 or break a 23. And then you have the confluence of the divergence. And then you have the momentum flipping. And then you have the momentum, or you have the MACD flipping. And then you have the momentum flipping, right? So that momentum flips right here, right near the trend break, right? So if you drew a trend line through here, draw a set of fibs. Now you have a lot of things cooking of why you want to take this trade. Okay, and that's how we can use MACD, right? It also can keep us out of bad trades, right? A lot of people like the counter trend trade. The problem with counter trend trading is usually you're counter trend trading strong momentum that's in the opposite direction of what you're trying to trade. Okay, that's how also we can use MACD, right? Keep us out of bad entries. All right, bearish divergence into the exact opposite, okay? So when price is moving opposite of a recent MACD crossover, the zero line, okay? So over the zero line when we're in bullish territory, but we get a bearish crossover, inverse momentum divergence, okay? Structure divergence, it's the same thing, except it's just flipped, all right? You got prices making higher highs, but you have the MACD making lower highs. So basically right here, got an example, okay? We got a significant uptrend in price, but yet we have a significant downtrend in momentum, okay? What do we get? We get a little M pattern formed, right? And basically you can see here that even though we're kind of chopping in here, we have, once this flips over through the zero line, okay, and once you break trend, which almost happens at the same time, you then get the steady stair step down, okay? We can just use this as another way of having confluence. Okay, structure, we have higher highs, okay? Our C point's higher than our A point, but yet our A point is higher than our C point on the momentum side. Okay, so you have a downtrend in momentum and an uptrend in price, all right? And look how long it takes to actually get the move down. I mean, you get a little scalp move down, right? But you kind of get some games here before we get the real move, okay? So again, on higher time frames, it takes longer for it to realize, okay? So keep that in mind. Just because you see it doesn't mean you play it. You want it with confluence of other items, okay? Fibs, patterns, SR zones, etc. Okay? It's the thing I've been preaching the entire time, guys. We want as much confluence as possible. So just a little bit on divergence. Divergence does not mean reversal, but it usually does mean eventual reversal, okay? Kind of like I said, sometimes it takes a long time for it to realize. It's more reliable on the 15-minute or higher. Obviously, we use it as confluence, and you're going to see it commonly with M and W patterns. And what's also important with this too is it can be a sign for you to take profit. Okay, let's say you're in a swing trade and you're noticing a divergence on the MACD, whether it be, you know, the inverse momentum or the structure divergence. That should be cause for you to take some profit if you haven't. Okay, it should be a signal of, okay, it's no different than like the candlestick patterns or VPA. It's used as a signal for potential trend reversal. Must have played that twice. Let's see. Oh, okay. So MACD Confluence, okay? And this is probably what I use most commonly with MACD. When we're taking day trades or shorter swing trades, we want the MACD to be aligned on all the time frames, okay? Because the MACD is specific to its own time frame, okay? It's not going to be the same. A 1 minute is not going to be the same as the 5 or the 15. 1 minute MACD is going to flip a lot faster than the 15 minute. 15 minutes is going to flip a lot faster than 1 hour. Okay. So specifically in day trades, we want the 1, the 5, and the 15 to be aligned. Okay. Now you can take trades with them not aligned, but you're not going to get that nice all-day trender. Okay. Or a nice 3 or 4 point move. It's more of a scalp. Okay. We need momentum and volume. And usually they come together. Okay. Got to have gas to make the car go. It's no different with the stocks. You need volume, you need momentum to get explosive moves, which is what we want to play. Okay. So when they're not aligned, all right, it's okay to take the trade, but you need to temper your expectations. Okay. So let's say, you know, the one on the 5 in our line, but the 15 is still, you know, bearish, but you're trying to play a bullish move from, you know, let's just say an 11 to the 38. Well, maybe you should take more profit of the 23 than you normally would, okay? Because you don't have the momentum behind you to get that explosive movement, okay? It should create some bias for your trading plan. Should affect where you take profit and how much profit you take. If they're not aligned, it should temper your expectations, okay? When momentum is aligned, we have a much higher chance of a larger move, okay? So what I did here is I just brought up the same chart. This is the 1 minute, this is the 5 minute, this is 15 minute, okay? And basically what I have down here is I have crossovers marked with arrows at each time frame. So this on this first one we have the smaller crossover, okay, on the 1 minute, which is this arrow. And then we got the 5 minute on this arrow, okay, on the bigger arrow. And then you can see it over here on the 15, right? Notice when the 1 minute crosses over here, right, we get a pop, but the 5 minute hasn't crossed yet, right? We're still bearish. We're in a bearish cross, MACD crossover, and we're also bearish under the 0 line, okay? So even though we get this nice little pop, right, you're not going to get an explosive move like breaking high a day, right, or breaking pre-market high, because we don't have the momentum there. Even though we have strong momentum coming in on the 1, right, where we flip bullish, the 5 is still on a downtrend and still on the bearish side. The 15 is still in a downtrend and coming into the bearish side, right? And that's why this pop is limited and you get the continuation downwards, right? So when the 5 minute crosses over, okay, which is further over here on the 1 minute, you can see it here on the 5 minute, on the 15, we get a nicer trend up, right? Look how much cleaner this 15 is than this 15. This is choppy as shit, okay? At least here we have a significant trend. The 5, we have a trend, okay? So when these start to get in line, we start to get basically less chop and more predictable moves, okay? This is why we want to see them aligned. Example over here, okay? So the original 1 minute crosses over here, right? And what do we have on the 1? Just a bunch of chop, right? Kind of hard to play. You get a nice little explosive movement here, chop, 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 chop. On the 5 minute, you see the same thing. The first arrow is when the 1 minute crosses over. What do you see down here? Just chop base, chop base. On the 15, what do you see? Still more chop and base, okay? The second arrow is when the 5 crosses over, which is over here. Okay, that's basically where the start of this trend starts, okay? You can see we had a slight uptrend with the 1 minute crossover. Once we get the 5, we start to switch the angle of this trend line, okay? We start getting a stronger move, okay? And then finally, when the 15 goes, just basically a candle and a half on the 5 minute afterwards of when the 5 momentum flipped, then we get the beautiful trend up, okay? 1 crosses over, chop. 5 crosses over, less chop, is starting to create trend. The 15 crosses over, and then we get the nice move we're looking for. So, conclusion, we want to trade momentum, okay? We want to trade explosive movements. That's how you catch the options chain off guard. Okay, we want to avoid chop. MACD is a tool that can help us catch trend plays. It's what can help us do that. It can provide confluence and bias for us to take those plays. MACD crossover is not a sole reason to enter a trade. Okay, we use it as confluence. Just like anything else, you want as many items as possible to enter a trade. And we want the MACD to be lined up on multiple time frames. Okay, the more time frames they're lined up, the more likely you are to get a trending play. Doesn't mean you can't have some small pullbacks in it, right? Or small bounces. But you're much more likely to get a nice stress-free movement out of the stock, which is what we want. Okay. So I think MACD is pretty valuable. I'm starting to use it more. Honestly, I should have been using it more before, but I honestly didn't just put enough time into it. And I started putting more time into it a couple months ago, and I'm glad I did. So hope this was helpful, and hopefully you guys can kind of see MACD in a different light, and hope it helps you guys out.